Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths behind the corporate world. And if you are ready for some serious financial deep dives, then buckle up because today we are about to crack open the financial report of Nushares ETF Trust. And trust me, this one has a few surprises up its sleeve. We're talking about multiple and traded funds here, Nuveen's lineup of ESG-focused ETFs, all reporting their annual shareholder results for October 2025. And while most of the numbers look pretty standard, there is a story unfolding in the performance data and investment strategies that is worth paying attention to, especially if you are someone who likes to see how these big investment companies really operate on the ground floor. So Nushares ETF Trust is the umbrella company for all these different funds we are looking at today, and it is filing a certified shareholder report, which is essentially its annual report to its investors, and it is a treasure trove of information if you know where to look. The reporting period for these funds ends on the 31st of October 2025, and they are giving us the rundown on how they performed, how they invested your money, and what changes are happening behind the scenes. Let's kick things off with the Nuveen ESG Dividend ETF, or NUDV, as it is known by its ticker symbol. Now, this fund is focused on dividend-paying stocks that also meet ESG environmental, social, and governance criteria. For its one-year performance, NUDV saw a total return of 4.75% at its net asset value. Its own custom index, the Nuveen ESG USA High Dividend Yield Index, returned slightly more at 5.02%. This small difference is mostly due to the fees the fund charges, which is totally normal. But here is where it gets interesting. Compare NUDV to its base index, the MSCI. USA Index, which is a broad measure of the US stock market. That index returned a whopping 21.89% over the same period. That is a massive difference, and it tells us something important about how this fund and its strategy performed in the last year. The report points to specific drivers for this underperformance, including underweighting and poor security selection in the information technology sector, specifically missing out on big players like Broadcom Incorporated and Nvidia Corporation. On the flip side, they had overweights in sectors like consumer staples and real estate, which may have dragged performance down. It shows how critical it is to pick the right stocks even within the ESG space. Next up, we have the Nuveen ESG Emerging Markets Equity ETF, or NUM. This fund focuses on companies in emerging markets that also meet ESG standards. This fund actually had a pretty strong year, ending the 31st of October 2025 with a total return of 24.42% on its net asset value. This was very close to its own custom index, Nuveen ESG Emerging Markets Equity Index, which returned 24.94%. However, it did underperform its base index, the MSCI Emerging Markets Index Net, which returned 27.91%. The report highlights good security selection in the industrials and financial sectors as contributors, but detractors included underperformance in consumer discretionary and materials sectors. Then there is the Nuveen ESG International Developed Markets Equity ETF, or NUDBEM. This fund invests in companies in developed international markets that meet ESG criteria. This one had a solid year with a 23.63% return at NAV. It even outperformed its base index, the MSCI AF E-Index Net, which returned 23.03%. The report points to strong security selection in communication services and financial sectors as contributors, while healthcare and industrials detracted from performance. It is a good reminder that international markets can offer different opportunities and risks. Let's talk about the Nuveen ESG Large Cap ETF, or NULC. This fund invests in large US companies that meet ESG standards. For its one-year performance ending the 31st of October 2025, NULC returned 17.72% at NAV. Its custom index, the Nuveen ESG USA Large Cap Index, returned 17.98%. Again, very close, but it significantly underperformed the broad MSCI USA Index, which, as we saw with NUDV, had a stellar year, returning 21.89%. Detractors included security selection in communication services and information technology sectors. Moving on to the Nuveen ESG Large Cap Growth ETF, or NULG. This fund focuses on large US growth companies that meet ESG standards. It had a very strong year, posting a 23.51% return. It was very close to its custom index, Nuveen ESG USA Large Cap Growth Index, at 23.96%, but it also significantly underperformed the MSCI USA Growth Index, which was up a massive 34.61%. This highlights the challenge of growth strategies when the market is favoring them so heavily. Missing key tech players was a drag here. Next, we have the Nuveen ESG Large Cap Value ETF, or NOLV. This fund targets large US value companies with ESG criteria. It returned 11.02%, outperforming its base index, the MSCI USA Value Index, which returned 8.79%. This shows that in a year where growth stocks soared, value stocks also had their moments, and this fund seems to have navigated that terrain well. The report mentions security selection in healthcare and communication services as contributors. Now let's look at the Nuveen ESG Mid-Cap Growth ETF, or NUNG. This fund invests in mid-sized DAS growth companies with ESG focus. It had a more modest return of 8.51% for the year. This significantly underperformed the MSCI USA Mid-Cap Growth Index, which was up 20.09%. Detractors included security selection in information technology and industrial sectors, and the report mentions a lack of exposure to key players in those areas. Following that is the Nuveen ESG Mid-Cap Value ETF, or NUMV. This fund targets mid-sized DAS value companies with ESG principles. It posted a return of 9.70% for the year, which significantly outperformed the MSCI USA Mid-Cap Value Index at 5.20%. This is another instance where value investing did well, and this fund capitalized on that trend. Security selection in healthcare and information technology were key contributors. We also have the Nuveen ESG Small Cap ETF, or NUSC. This fund focuses on small US companies that meet ESG standards. It had a return of 6.32% for the year, which significantly underperformed the MSCI USA Small Cap Index at 12.01%. The report points to security selection in industrials and energy as contributors, but detractors included healthcare and information technology sectors. Small cap stocks historically can be more volatile, and this fund seems to have faced some headwinds. Let's shift gears to the Nuveen Dividend Growth ETF, or NDVG. This fund is focused on dividend-paying companies. It returned 10.49% for the year, which significantly underperformed the S&P P500 index, which soared by 21.45%. The report highlights overweights to Broadcom Incorporated and an out-of-benchmark position in Taiwan Semiconductor Manufacturing Co. Ltd. as contributors, but detractors included an underweight to communication services and underperformance in healthcare. The lack of exposure to Nvidia Corporation was also a significant detractor. Then we have the Nuveen Growth Opportunities ETF, or NUGO. This fund seeks growth opportunities. It had a strong year with a return of 26.72%, which was good, but it underperformed the Russell 1000 Growth Index, which returned 30.52%. Overweights to Broadcom Incorporated and security selection in industrials were contributors, but detractors included healthcare and consumer discretionary sectors. And finally, the Nuveen Winslow Large Cap Growth ESG ETF, or NWLG. This fund also focuses on large cap growth with an ESG overlay. It returned 23.57%, which underperformed the Russell 1000 Growth Index at 30.52%. While it had some strong contributions, security selection in information technology and financials were detractors. Now let's quickly glance at some of the financial statistics. For example, the Nuveen ESG Dividend ETF, which we looked at first, has fund net assets of about $34.7 million and holds 86 different companies. That gives us a sense of the scale of these operations. And for NUDV, the total management fees paid for the year were $61,086. This is just a small slice of the overall pie, but it is good to see these numbers broken down. When we dive into the actual investments, which is typically a long list starting around page 4 of these filings, you can see the massive scale of these funds. For instance, the Nuveen ESG Emerging Markets Equity ETF NUDEM has investments totaling over $329 million in common stocks alone. The Nuveen ESG Dividend ETF NUDV, its portfolio consists of 99.7% in common stocks valued at over $34.6 million. This is a very traditional equity-focused approach. In NUDV, for example, 3.1% of its assets are in communication services companies like Comcast Corporation and Verizon Communications Incorporated, but a huge chunk, over 23%, is allocated to financials, including major banks like Bank of America Corporation and Citigroup Incorporated. That is a significant concentration, showing their belief in that sector. Looking at NUDEM again, a substantial 21.7% is in financials with major holdings in Agricultural Bank of China Limited and China Construction Bank Corporation. This indicates a heavy bet on emerging market financials. And that fund also has a significant 23.2% in information technology with key holdings in Taiwan Semiconductor Manufacturing Company, Ltd and Infosys Limited. This shows a dual focus on financials and tech in emerging markets. Now for Nuveen ESG International Developed Markets Equity ETF, its common stocks alone are valued at over $618 million. That is a really big fund. Again, financials are a major focus, making up 25% 25.6% of the portfolio, with companies like Banco, Santander, SA, and Allianz. And surprisingly, industrials are also a big chunk at 20.2%, with holdings like AB Limited and Alstom SA. This international fund is quite diversified within its developed markets mandate. Overall, these reports show a consistent theme across the Nuveen ESG ETFs. They are committed to their ESG mandates, but the performance varies significantly based on market conditions and sector bets. The US-focused large cap and growth funds, for example, stumbled a bit against the broader market in the last year, which was heavily driven by a few big tech winners. The international and value-focused funds, however, showed stronger relative performance in this particular reporting period. The fact that they have such a diverse range of strategies, from dividend growth to emerging markets to ESG-focused large caps, suggests they are trying to cater to a wide array of investor needs and risk appetites. It is worth noting the active management approach apparent in their security selection commentary, which leads to both outperformance and underperformance relative to benchmarks. This filing highlights the ongoing challenge for any active manager, especially in ESG, which has to balance the ethical mandate with the fiduciary duty to generate competitive returns. We saw funds that significantly underperformed broad market indexes and others that managed to do so or even outperform. It underscores that strategy matters, but so does execution. The concentration in financials and technology across several funds, as well as the specific country allocations in emerging markets, point to a deliberate investment thesis. It is not just random stock picking. They have a plan based on their ESG criteria and their view of market opportunities. The changes in accounting firms from KPMG to PwC are also a standard part of corporate governance and likely indicate a routine rotation or an assessment of audit quality. In conclusion, Nuveen's ESG ETFs are navigating a complex market landscape. While their ESG focus is a clear differentiator, the actual investment performance is as varied as you would expect across different asset classes and strategies. Investors in these funds should really understand the specific strategy of each ETF, the underlying index it aims to track, and critically analyze the performance drivers mentioned in these reports. The numbers clearly show that no matter how good the intentions, ESG investing still needs to deliver solid financial results to justify its existence, and these reports give investors a detailed look at how well they are currently doing just that. What is your take on these ETF performances and the ESG investing landscape? Do you think the deviations from benchmarks are justified by the ESG mandate, or are these funds missing the mark in terms of pure investment returns? Drop your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate reporting. You can also join our Discord community for more exclusive content and discussions linked in the description. Thanks for watching. See you next time.